And the Kenya government has borrowed $1 billion via a syndicated loan from commercial banks, $200 million more than anticipated, according to a report by Thomson Reuters. The borrowed funds are set to meet infrastructure financing, even as the country works towards plugging the huge infrastructure deficit. Early this year, the National Treasury in March disclosed it was raising a total of $1.55 billion in syndicated loans, with $800 million coming from commercial banks and the rest from development finance banks. The $1 billion loan was split into a 2-year tranche and a 3-year tranche. The loan arrangement was arranged by Citigroup, Rand Marchant, and Standard Bank and Standard Chartered Bank. All right. Moving on, Central Bank's board chairman Mohamed Nyaoga has come out to assure market players that the banking sector remains resilient in spite of a slowdown in credit uptake. Nyaoga told KTN Business Today that by Kenya having a number of foreign banks showing interest to set up shop, this was a show of confidence in the financial sector. So far, several leaders from Gulf countries have expressed intent to put up subsidiaries in the country.
It is clear when you see new players coming to the market that there's still a lot of confidence in our financial system. As Central Bank, you remember, we have come up with a new normal. The new normal basically is upping the governance game. We want to make sure that we refine the governance system within the banks so that they can serve the consumers better. Now, in terms of enforcement of our regulations, we are really up to the game. And the reason is that we have had a few problems in the past. You remember the three banks that went down. It was not systemic. These were issues that were really peculiar to those banks. But we have learned lessons. But Kenya, again, is not alone in this game. We saw the global financial crisis. We have learned from it. And we are trying to make sure that we have global best practices inculcated in our financial system.